Well, welcome to this FarmDoc Daily Live Coronavirus and Ag webinar, the impact of the coronavirus pandemic on the livestock markets. Our panelists today include Lee Schulz, he's with Iowa State University, and Todd Hubbs from the University of Illinois. I'm Illinois Extension's Todd Gleason. I'll take a moment now, Lee, to introduce Todd Hubbs. He's the agricultural economist here on campus, and you can read more from him on the FarmDoc Daily website each and every week, or most weeks, on Monday afternoons in the weekly outlook. Thanks, Todd, for being with us. The program is yours for the day.
Thank you, Todd. It's good to be here, and I'd like to welcome everybody to this webinar. I think Lee's going to provide a lot of good information today. So if you click to the next slide, Lee. I just want to briefly go over where we've been and what we've seen since the start of the year and the COVID-19 outbreak in prices. And when we're talking about livestock producers, I think one of the few bright spots with this huge shock to the economy and all the supply chains associated with ag in general, but we've seen some really tough issues with livestock in particular, is that feed prices have come down significantly. We saw corn and soybeans rally a little bit yesterday, and they're sort of coming back again today. When you look at it relative to the S&P 500, which is down a little over 2.5% today, probably because the president started mentioning tariffs again against China. We've seen soybeans and corn come back a little bit today, giving up some of those gains yesterday. But overall, barring that little bump in meal in March, we've seen corn and soybean meal come down. You can go to the next slide, please, Lee. But when we compare it to what, and these are all futures prices, June and July futures prices, what's happened in the live cattle and hog markets. Hogs are down minus 37.4. And gladly we've seen them, both them and live cattle start to move back up. And today we've seen a nice little rally. And so it's put livestock producers in a really tough position. And these are futures prices. What's going on in the spot markets has even been more difficult. And I think what we're going to see today, and we've got the right person to talk about this, I think, with Lee, sort of putting shape to what's happened over the last couple of months. Can you go to the next slide, Lee? I think most of us know what's happened, but just to give a brief overview of what's been going on, you've probably seen these headlines in your local paper or somewhere on the internet. As we came into March and the COVID virus started to spread through the Midwest, we saw packing plants shut down. And since then, we've seen numerous shutters and slow down production. It's backing up livestock back into the countryside, putting pressure on cash prices, and culminating this week in President Trump signing an executive order to keep meat plants open. And there's been a little bit of a push on, are we going to have a meat shortage? So there's a lot of scary information out there in the news. I think what we're going to see today is maybe get some clarity on where we're headed and what these livestock markets are looking like. So go ahead, Lee.
All right. Thanks, Todd Hubbs. Let's take a quick poll. Answer this question for us, if you would. What do you think fourth quarter lean hog prices will be? Just select one of the following: below $50, $50 to $55 for 100 pounds, 55 to 60, 60 to 65, and above $65. So I suspect a lot of you that are pork producers will have a good handle on this. The rest of you may not keep as close track of what the prices are. But go ahead and put those numbers in. I think it's quite likely that Jim, we'll hold off for a hit here for just a bit, but I'm not certain how many of the audience will have a good understanding of what. For 55 to 60, and then 60 to 65 at 11%, above $65 at 5%. I'll turn our attention now to Lee Schulz. He is with Iowa State, where he covers these markets. Lee, I don't know a whole lot about you. Why don't you tell me a little bit about yourself, your background, what you do for Iowa State, and then what you think about the poll and your expectations for the prices.
Good day to all of our listeners. Thank you for joining us, and thank you to the FarmDoc team for setting up this webinar and giving me the opportunity to talk about some of these markets. I've been at Iowa State University since May of 2012. I came here as an assistant professor and have since been promoted and also serve as the statewide specialist on livestock economics and markets. And in the short time that I've been here at Iowa State, I've thought I'd seen a lot with coming here in 2012 and dealing with the drought situation and the impact that had on the farmers and livestock producers, especially as that's the sector that I followed. And then the situation with porcine and epidemic diarrhea virus in 2013 and 14 for the pork industry and the large expansionary phase that we've seen in the cattle industry. And really that's been nothing compared to what we've seen here. And I don't want to downplay all of what went on during that period of time, but this has shaken the livestock markets tremendously. And when we look at really who is suffering right now, it is the producers. They're having to make difficult decisions. And really, we're right in the meat of this as the impacts are some of the largest, what we're seeing right now and expected to see here in May. I want to take a moment to comment on these forecasts for fourth quarter hog futures or hog prices. And really, the audience here are pretty good forecasters. If we look at lean hog futures for October and December, they're averaging roughly $57 per hundredweight. And we've seen a rally here over the last days and weeks. And so we had been trading below that 55 range. So I think that's a pretty good guess if we're using futures market as our best guess of those prices. But we know that these markets have been very volatile and are certainly being impacted by both the supply situation that we're facing right now and then the uncertainty about demand of what demand will be going forward, given we know COVID-19 has impacted the folks' income and their ability to spend dollars on protein, not just here in the United States, but globally. Contrary to this picture, we're going to mostly focus on the pork market today. I don't have enough time to even do the pork market but I think really focusing on the situation that pork industry is facing, and maybe we can learn a little bit from that situation for the cattle sector as well. I do want to touch on a few cattle sector comments. I highlight my intro slide here for my contact information. If anyone wanted to follow up after this webinar, I would be happy to via the phone or the email. I like to always start out with kind of just given the supply situation. And when we look at the most recent hog and pigs report, this was 5 weeks and a day ago, but it really feels like an eternity ago, given what has happened in these markets. Having this information is critical, though. And so I do want to note that USDA plays a vital role in providing these inventories for analysts, for industry to help understand that supply situation. And the supply numbers that are really critical right now are those market hog inventory numbers, because these are the slaughter levels that we're facing here for the next 6 months. We look at that 180 pounds and over category. Those were the hogs, if I do some rough math, that would have been marketed in March and April. Those were large inventories, 6.5% over a year ago when we look at the U.S. in totality, and when we look at Iowa, it was up 12, almost 13%. Now, I think some of those hogs were actually pulled ahead a little bit in March, and that maybe helped the situation in April and further down the line. And then as we look at the next weight categories, they weren't as large compared to year-ago levels, especially here in Iowa, but they were larger, and noting that last year was rather large numbers. So if you add some of a percent to a large number, it's still a really large number. And then as we get to the new pig crop, those are going to be marketed later summer, but those still have implications given this backup that we're causing on the farm due to the slaughter capacity issue. Now, I'd first like to highlight, and I'm going to come back to this too, talking about the meat supply. And so we do not have a shortage in the sense that we have sufficient livestock. When you look at USDA's projections for pork production in 2020, it was up 5%. The first quarter, which is already behind us, and there wasn't really any challenges, many there, it was up 8%. Now, if I look at total meat, it's a little bit lower, but it was up they're projecting up 3% for 2020. First quarter was up about 7%. Because of the decisions that producers made, for example, in the pork industry 10 months ago, and if I want to include the raising of those gilts, it's 18 months ago. Cattle industry, it's even longer. That's dictating the production that we're seeing today. And so that livestock is relatively assured. What the challenge is converting that livestock into consumable products, both here domestically and on the export market. You'll also note that we're at record production following up from what we've seen in 2019. Coming into this year, we were expecting higher prices for livestock producers with higher production. You only get that one way, with a increased shift in demand. And then we seen the situation present itself as we got into April, where now slaughter levels had been running above year-ago levels. This is daily federally inspected hog slaughter, just weekdays. I'm not included the Saturdays here for ease of presentation. And slaughter was running above year-ago levels just like we expected. And then that first red dip is actually a little bit misleading. It wasn't a major impact from the slowdown. We did see some slowdowns, but that was actually looking at, we had an early Easter this year. So with that holiday week, we've seen some lower slaughter. But you've seen it jump back up, but then you've seen it drastically erode here, where if I compare through Thursday's data, which I had when I built this talk, we were down 40% compared to a year ago in that federally inspected hog slaughter. Compared to the previous week, we were down 21%. You'll see the number of hogs, the sheer number of hogs that's showing is backing up on the farm because of the issue with slaughter capacity. Cattle situation of a very similar scenario here, where large percentage decreases from year-ago levels and continued to decline week over week as well. Now, I will highlight here, these are estimated, the estimated where I have that black bar there. Those are likely to change in a situation like this, where it's a very fluid situation on the operating of these packing plants, at what rates they're operating. And so there's likely to be some adjustments, possibly better, hopefully better, but also possibly lower as well when we look at this daily slaughter data. So the daily slaughter really gives us a good snapshot and almost real-time snapshot, but also we need to take a look at the weekly data to really understand how this is playing out as far as reduced slaughter levels. Now, when I look at the situation presented by the slaughter capacity reductions, it's not typical in the sense of a typical capacity issue. Historically, we have seen issues with packing plants go offline or see reduced operation. Sometimes that's because of maintenance. Sometimes that's because of an event like a fire at a packing plant. But with that situation, it's usually relatively isolated. We know the path to recovery to get that packing plant back online. The situation here is much different in that it's really focused on our labor force. And when we came into this situation, pre-COVID-19, we were at historically low in modern day history unemployment rates. February nationally was 3.5%. Obviously in March we jumped up. April we're going to jump up again. Now I like to use this other figure from the Bureau of Labor Statistics that looks at the number of unemployed persons per job opening. And in February that was 0.8. So how I interpret this, if I'm looking to hire someone, I can only expect to hire 0.8 of a person. that shows the shortage that we have in labor. And why I term it a shortage and not just a tight supply is we've seen wage rates increasing, especially in production ag, especially at the processing level, to attract those workers to that growing sector of the industry. And we've just not been able to create enough workers that are needed for the production levels that we've seen. Now, when we look further here, these are the packing plants. That this was a list and map put together by the Pork Checkoff that shows the distribution of these packing plants. And as you would expect, they're mostly focused right here in the Midwest, in Iowa or around the bordering states. Yes, we have some in the Eastern Corn Belt. We have some on the East Coast and the West Coast. But the majority and the volume, for the most part, is focused right here in the Midwest. Now, the issue with this is when you look at that labor. So if we have a labor situation where it's very tight supply or in shortage, and then that labor is impacted, that'll have detrimental effects on the ability to operate these packing plants. I came across these statistics from the Bureau of Labor Statistics, and again, I think this is very showing. When we look here in Iowa, for every 1,000 jobs, 3 of them are in the slaughters and meat packers sector. So they're already drawing a big part of that population here in Iowa, workers for that sector of the industry. And then you go even more concentrated, say the Sioux City region, which serves Iowa, Nebraska, and South Dakota. For every 1,000 jobs, 15 are in the slaughters and meat packers. And as we've seen with COVID-19, and we're reaching our peak here in the Midwest, and more workers being affected by it, both directly and indirectly, that's having a detrimental effect on our ability to operate these packing plants. Now, also, I think it's really important to understand the breakdown of these packing plants and our ability to slaughter hogs. And the cattle situation, this is much a similar chart if I would show this for cattle. But USDA, annually, they release the federally inspected plants and heads slaughtered by size group. They just did it here last week. And what this shows is there's a small group of packers at the top that slaughter over 3 million head per year. And then there's a large share of packers, when we look at the number of packers in this really small size group, the 1 to 99. But they slaughter 0.1% of the 129 million head of hogs that are slaughtered annually, whereas 62% are slaughtered by the large packers out there. And we've seen COVID-19 has certainly impacted across the packing industry, but the impacts when you close down or slow down a large packing plant, say for example that slaughters 20,000 head per day, that's taking a big chunk out of that sector that slaughters a majority of the hogs that are produced. I thought Jason Lust provided a great example of this on his blog, and he titled this the Scale of the Problem. And I highlighted it here because I really think it shows the issue that we're faced with, and that there's no simple solution to work through this backlog of hogs that day after day continues to present itself. So if we look at the normal national processing capacity, it's about 510,000 head per day, but for simple math, let's just say 500,000 head per day. And then say we have a slowdown in about 40% of that 500,000 head that we can slaughter. And we've seen that here. I think early on we had been about 25 to 30%, and then as of late, I think we've got even to about 40%. So if I do that math, 500,000 times 40%, that's 200,000 market-ready hogs are backed up on the farm each and every single day. If you do that for 5 days, you get 1 million hogs are backed up in a week. Now, in the short term, there's things that can be done. Those hogs can be slowed down, the growth there. We can change rations. While that's not an easy task by any means, that can be done. We can crowd those buildings a little bit, still maintaining the animal welfare that is needed. But those are very short-term things that can be done to mitigate some of this impact. And producers have done that at times in the past when we've seen supplies larger than capacity, but usually it's a couple weeks to work through that situation. So let's assume that a small plant that could slaughter about 200 head per day, and if I go back to this one, that would be in that size category of 10,000 to 100,000 hogs per year. So there's 39 of those packers out there. We could take a smaller group and the numbers are just going to look larger. But the takeaway here is how many extra days would that 200 head per day plant have to run to just catch up for 1 day's lost production in that 20,000 head per day? Well, it's 100 extra days. Or you'd have to build 100 brand new of those 200 head per day packing plants to work through that backlog. And so that's the tremendous challenge that we're faced with right now. We have the fixed infrastructure, both on the farm and at the packing plant level. And now working through this backlog of hogs is a tremendous challenge. Now, if we think about, well, what's the impact on prices? And I highlight a fact sheet here I did with a colleague, Glenn Tonser at Kansas State University. And you'll see we did this in early April in anticipation of the issues that we're going to be presented with. Now, but by any means, we didn't know what the issues were going to be, but we had heard about slowdowns, possible closures of packing plants, and so just to try to get a handle of what's the impact going to be to prices. We ran some simple models just using hog prices. We also did this for cattle as well, and then looking at capacity utilization and then a trend. That graph there shows capacity utilization, and you'll note it's over 100%. We really don't know capacity utilization. It's a tough number to measure, so we kind of just use historical slaughter relationships to back it out. So don't worry so much about the levels there, but it's really just showing that we're at some of the peak capacity utilization even before coming into this situation. So there wasn't a lot of slack in the system or cushion that could absorb additional hogs. So we run that model. It shows that an increase in packing plant capacity utilization, or look at it in another way, is a decrease in capacity of 1% leads to a 1.82% decrease in hog prices. Now, if I multiply that by a factor of 10, 20, 30, you'll see the impacts on prices there from 18% up to 54% potentially. Now, important to note in this analysis is we're kind of working outside the bounds of historical data, right? In the situation that we're just using this historical data to help us with this understanding these relationships. But we're in a situation that's certainly outside of those bounds. So, that's going to be difficult to say forecast what those prices actually would have been given our model. But it overall does fairly align with what we expect, obviously lower prices. And when I compare prices, the previous week after we seen this recent rally, prices were down 40% compared to a year ago. In April 17th compared to April 19th of the year previous. If I compare to the high point this year, it was down 27%. Now after this recent rally, they're down from 20 to 35% or so. I highlight here, I'm using weekly data because that's a lot how a lot of my charts are built, but it's important now to look at where the daily's at, because actually we've seen a rally, and when we look at the Iowa, Minnesota barrel gilt base price for all purchase arrangements, it was at 61.19 on April 29th. So again, a significant rally from what it was when we looked at the previous week. Now, also important to look at this is all hog prices aren't the same as well. And so when we look across the different purchase arrangements for hogs, you see a big dispersion between negotiated prices and the rest of the formulas and other purchase arrangements, roughly 40% or $25 per hundredweight when we look at comparisons of those prices. Now, that's a small percentage of the volume, but it shows the drastic divergence in those prices. And in situations like this, it does point to issues with hog value determination, price discovery, and the importance of understanding this information because of the large dispersion in these prices. I think it's important also to know what's been done to the feeder pig market. And I highlight here the SEW 10 to 12 pound pigs and specifically the cash market. Those prices have approached zero. And this is as we would expect as finishing spaces are being maintained by market ready hogs. These prices have relatively approached zero for the cash market. Now, the formula market is still maintained in the sense that it's much higher than the cash market. Those formula prices are based on a cost of production potentially or using a derivative of the lean hog futures. I also highlight the last time these prices were this low. And 2008 was recessionary impact. They did actually rebound after they set in that low of $5.78 per head. And then after that, it was August 2012. And many of us remember that was $7, $8 corn period, which dropped those prices much lower. In both of those cases, prices did recover. I don't want to say fairly quickly or fairly large, but they did recover. And that's certainly the hope here that we get some value back in these feeder pigs. Now, when I put the prices in collectively in a model here we have at Iowa State University. It's called the Estimated Livestock Returns. And I show this model here for wean to finish. What this model is it's a budgeting model that takes inputs at all the costs of those production and then takes hog prices as the output. Now, this is a cash market model, so it doesn't assume any risk management or forward pricing. Kind of just takes the price I would take in a particular month. When I run this model, both historical and then to the right there, the blue line shows what the forecasts are. So forecasting now roughly a $16 per head loss in 2020 with a range of about 34 per head loss, which is what we're facing here in April and May. And then even later into the summer, and maybe a time of profitability as the seasonally higher August contract potentially there. And then as we get into 2020, some possible profit out there. Now, I want to highlight here that these forecasts are based on lean hog futures prices as of yesterday. And so what I do is I adjust those for a 3-year historical basis here in Iowa and Minnesota to give you those forecasts. Why I highlight that is if I go back on April 17th, I was forecasting about a $30 per head loss and to the tune of almost $60 per head loss when we look at the near term of what those closeouts would be in April and May. And actually not even clearing a profit here in 2020. The best case would be a loss of about $11 per head. Now, I also want to highlight the cattle sector because we've certainly seen significant impacts on cattle prices. And again, the same type of modeling approach for finishing yearling steers here in Iowa. And it shows that for 2020, that average loss would be about $128 per head. Now, if you look back historically, there hasn't been many years of profitability in cattle finishing. There's been some months there. On average, it's that economic profits are close to zero and maybe even below in this sense. This year looks to be, as we look at current futures prices, roughly in that 2016 to 2015 range, more closely to 2016. The one thing that this model does miss, as I mentioned, I use three-year historical average basis levels. Well, we're seeing very strong basis levels for cattle right now. To the tune of anywhere from about $7 over the board to upwards of about $16 over the board. So when you use historical, it's not quite that high. And so, if I would use those real-time ones, that would show a little bit better situation for cattle finishing, certainly in the red, certainly much lower values than we've seen in the last year or so, last couple of years. And so that shows just what producers are facing right now, a tremendous price and financial impact to our producers. I want to transition here a little bit to talk about the meat availability issue. I know that's taken a lot of attention in the media to address some of that. Some co-authors and I, Dr. Glenn Tonser again at K-State and Dr. Jason Lusk at Purdue, looked at this in a fact sheet that we just released this week to kind of look at the situation. Is this a shortage or is this availability? And as I alluded to earlier, I think it's much more an availability issue in the sense that we're finding product at the grocery store, but it's just probably not in the form or the product that I'm necessarily used to buying. And we're also seeing higher prices. Where we've seen a real strong increase in prices for pork is the loin. The loin has increased significantly. Retail prices up about 15%, but range anywhere from about same as a year ago to up 55%. Also, there's been a big run on deli ham, both packaged and sliced, fresh there. Strong increase there as I think consumers now are purchasing much more of that product in the retail sector, and we're seeing attention to those products. If we've seen anything really below year-ago levels, it's kind of been some of the butt picnic products that I think maybe we just haven't seen the quantity movement at the food or at the grocery store level. I like to use this national retail report because it gives really, in my view, some of the best real-time prices. We don't have quantities, but we have some prices from retailers. They also break this down by region, but I just show you the national here. And they always kind of give just a bit of news for each week. And so the report for the next week will be out today. So this is the last week's report. It's always forward-looking. And in this report, they said that obviously feature activity is drastically lower than a year ago. Many locations have suspended or reduced ads, and prices are fairly mixed compared to year-ago levels. Now, pork production is actually still up year-to-date compared to a year ago, but that's because of the 8.1% increase we've seen in the first quarter. Now we've moved drastically lower than last year, drastically lower than the 5-year average. Hog weights are pretty telling in this situation. So we actually pulled some hogs forward, as I mentioned, in March. And so that actually had a little bit of a seasonal decline in those hog weights. But over the last few weeks, as we've seen hogs backed up on the farm with those reduced slaughter weights, we pushed those weights higher. And I fully anticipate we'll continue to push those weights higher until we work through this backlog of hogs. Pork cutout value, tremendous variability here where it put in some significant lows early in April and now rose to over $70 for the week ending 4/27. And as I looked at the daily data yesterday on the 30th, it was over 100 on the pork cutout. So much higher than what we've even seen in historical levels. Now, what's been driving this? Again, we're seeing strong retail prices of the loin, and that's what's really been increasing it. The loin on a value contribution basis to the cutout is up over $13. We've also seen some strength finally in the belly. The belly had really been dragging down that cutout for some time, but now we've seen some significant strength there. Only really down in the ham as we're moving past seasonal ham demand. And a bit down in the rib. A lot is talked about cold storage. Somewhat is because that provides a bit of a cushion for us as we've slowed down production at the processing level. Cold storage is up about 2% when we compare it to last March. We did draw down some of those stocks from February as we expected. But I think it's really important to somewhat understand what's the mix in cold storage. So cold storage is a variety of products. We have some idea of some, not as much of others, such as others and trimmings. But the big bulk of that, bellies, it contributes, I think, about 13% what's in cold storage, and it's up 34% from a year ago. You'll see where the percentages are for the other one. The belly issue is, yes, we are consuming less bacon. A lot of bacon is consumed in the food service and hospitality sector, but there's been a lot more stocks of bellies as of late pre-COVID-19. The reason why is we've really developed a strong demand for that bacon. And so over time, retailers have adjusted inventories to make sure they have some in cold storage that they could be pulled out of at times of peak demand. And so that has depressed those prices, where those prices have really escalated in the last couple of years when that became in short supply and retailers had to bid up to get that product. Finally, I want to end with the export situation, because I've heard some comments of, if we're talking about a meat shortage or availability issues, why do we just not slow down exports? I think the important thing to understand here is exports flow to the highest valued market. And a lot of times that value here in the United States can be zero or pretty close to zero, or much lower than the value that can be attracted on the world market. And I highlight there, and I purposely put that USMEF graphic below the value chart to show that it's propping it up. So variety meats, for example, China is a big market for us. Those products have very little value here in the US, have much more value in China. In February, USMEF calculated the export value for every hog. If we take a hog in February, it was roughly worth $132. The export value was almost $67 because of the value that we got on the export market. So about 50% was due to the export market. So a big thing is we are relied on in the United States here as a reliable, a consistent, a quality supplier. And I think we want to make sure that we maintain that. And that goes beyond just the value that we're attracting from each shipment of pork we send there. And this goes across all real proteins here, because that's why we've grown our pork industry, because of the demand both here domestically and on the export market. As we look at exports here, for the first 2 months of the year, they were up significantly, 41% by volume, 54% by value. That's using the official monthly data. We look at the weekly data through April 23rd that was just released yesterday, shows even more strength in accumulated exports. If we throw the outstanding sales on top of that, we're up about 60% for the year. And across all of our major markets, you really have to go down to Hong Kong before we see significant declines from year previous levels. So I want to finish with this slide, because I think this provides some optimism in the sense that we look at, and I arbitrarily picked October futures prices for hogs here on your left and cattle on your right. For hogs, we've certainly seen a rally over the last couple of weeks, really since about the second week of April or so. Certainly a lot of volatility, but we've hopefully put in that low, and we'll continue to work and see some demand pull that pulls those prices higher. Cattle, I think we've really stabilized those markets. Certainly about $92 per hundredweight really looks like a support plane for that October live cattle futures market. So with that, I will end my comments and take questions as we wrap up.
Hey, thanks so much, Lee. Lee Schulz, of course, is with Iowa State. Now, if you have questions for Lee or for Todd Hubbs from the University of Illinois, go ahead and put them in the questions section. We'll get to them in just a moment. We would like to thank all of our FarmDoc sponsors. They include TIAA, Center for Farmland Research, right here on campus. You can find them at farmland.illinois.edu, Compeer Financial, Farm Credit Illinois, the Corn Growers Association in the state of Illinois, and of course, FS Growmark, along with the Department of Agricultural and Consumer Economics. Coming up in the next couple of webinars, we'll talk on Tuesday of this week about how China's consumption patterns have been changing and agricultural trade with them. And then on Friday of next week, we'll take up agricultural law issues and the COVID-19 pandemic. There are a whole bunch of legal issues that we'll be working through, I'm sure, in future months. Now, let's take some questions for Lee Schulz and for Todd Hubbs. Lee, if you could go back to I think it's slide 14, which shows the daily hog slaughter. I have a question about the historical functions at this point. And the question essentially is this: does this normally trend down into the summer months? I think it's by about 65,000 head a day to 300 to 350,000 100,000 per week. And will that take pressure off of the marketplace?
That's a really good question, and the answer is yes. So there's obviously historically we've seen the seasonality in supplies, and that leads to seasonality in prices. So yes, the tightest slaughter levels are in the summer months with the highest prices, and that's really due to breeding. When you're breeding sows during the summer, you get fewer sows pregnant. That can have an impact on pigs per litter, all of that. And so then a year from then, yes, you get fewer slaughter supplies. And so, yes, to the degree that, that is going to provide some help in the sense that you don't need as much capacity. But the challenge is we were going to have higher supplies than a year ago. And dependent, it was dependent on what, if you looked at aggregate, it was up 2 to 3%. If you looked, some states may have been up more, some states may have been up less. So, where that state or where a particular producer is marketing those hogs would certainly dictate that. So yeah, so numbers are going to be higher than a year ago. But I think the real challenge is if we have this backlog of hogs, that pushes more supplies into those summer months. And so the challenge there is then we don't get some of that seasonal relief in the supplies. And a lot of times those plants, that's good time for maintenance for the hog industry when those plants are running a little bit less and ramping up for fourth quarter. We won't have that this year as we continue to push those supplies further into the summer potentially.
USDA has yet to put forth guidance on the Defense Production Act as it's related to the processing facilities. Most believe a large part of it has to do with legal liability. I'm wondering what your assessment early on of what they might be able to do is.
Yeah, so my reading of it, not a lot of details coming out of that. I think it's really important though to understand that you can order a plant to remain open. And first and foremost, these plants this is really a last resort to shut down operations after, first and foremost is making sure the safety, the health, the well-being of the workers is taken care of. But if we can maintain that, packers want to keep these plants open. And producers certainly want these plants to remain open, and we're doing all the options, putting physical distancing in. But if you get below a critical mass of labor and are not able to function these plants, that's when we've seen some of those closures. Now, you can, again, order that plant to stay open, but you can't order it to operate at a particular level. So having a plant stay open and having a plant operate at 80, 90, 100% of capacity is a very, very different thing. My hope here is that this puts more resources, even more resources. I know here in Iowa, a ton of resources have been devoted to the packing sector because it helps the producers too, in the sense of how do we maintain the operations of this critical infrastructure through increased testing, through other protective measures like PPE, through physical distancing. All of that, I think, hopefully part of this executive order is to get those resources there that can help maintain these operations.
Do you think they'll purchase equipment for installation in some of the operations? Will they purchase beef and poultry and pork, all of which is possible?
As far as a food buyer?
Yes, under the DPA.
Yes, I think everything and anything should obviously be talked about and be acted upon, because we're in a very critical state at the moment. And so when you look at, I think there's a lot of optimism, and maybe that's obviously too strong a word, but showing that beef and pork and really proteins in general are still in strong demand. We're facing these bottlenecks and challenges, but as we get into recovery, we want these industries to be there, be able to be producing and meeting that demand. So it's, again, I think we need to get immediate assistance to the form of producers financially, resources. Why? wise to just work through this very short-term situation, so that we can allow markets to work once we get out of this.
You think domestic demand for pork and beef later this summer will come back?
I would argue that it hasn't gone away. I think it's actually been stronger, because we've still seen very strong, and that's part of the availability issues, I think, is the fact that even at higher prices, even at that change in mix and products, you've still seen consumers really demand protein, and in particular beef and pork. And so that really has been part of those availability issues. And so I think, again, this is a situation where we've really changed how consumers make purchasing, right? It had typically been a food away from home and food in home. And now we've directed that to all food in home. And I know myself, and I suspect others, shop a lot differently when they go to the grocery store. We're not just buying today's meal or tonight's meal or tomorrow's meal. We may be buying for the next couple of weeks. And so I think we're seeing a lot of large purchases, not only stocking up, but just because I expect to be consuming these products over the next days and weeks. And so that's really, we've seen some strong demand at the retail level just in general.
I think this question may be for both you and Todd Hubbs. What impact will this downturn have on feed grain demand, especially for corn, over the short and long term? I suppose that starts with what you think, Lee Schulz, the production system looks like as we move forward.
Sure, and I think a lot of this is somewhat dictated by the length of this impact and how much of those ripple through effects will continue to occur. Remember, we're still at record large inventories of hogs. I think we've seen a bit of contraction in the sense of sow numbers from December to March, but we're actually still higher March of 2020 compared to 2019. Also in the hog industry, it's important to remember that we continue to see a great deal of efficiency. Pigs saved per litter has been running well above the recent averages we've seen. So we've produced more hogs and more pork with fewer sows. We've seen some increases in weights because of just the lower feed grain prices. And so all of that collectively, I think, suggests that there's still going to be some rather strong demand for our feed grains. At least when we look in the short term. Longer term, if we do see some contraction in these industries, they obviously have implications for feed grain demand in the coming years.
Todd Hubbs, have you thought about this one?
Yeah, I've thought about it quite a bit. I basically agree with Lee. I think in the short run, it's a bit of a boost to feed demand, particularly with the loss of distillers grains, as we've seen ethanol production fall off a cliff basically over the last month. In the longer run, it does really depend on how all this gets sorted out. I mean, we've heard of sow abortions and starting of euthanizing some hogs, and this could get pretty bad in the near term. You think about the cattle sector. You've heard a lot of feeders building up out in the countryside. Maybe the feedlots aren't taking as much, and we've seen the slaughter drop off in fed cattle as well. So I think the supply of livestock is going to be there. Maybe in the third and fourth quarter, we see a reversion instead of continued growth, maybe a reversion to what we saw last year, maybe a little bit lower in the fourth quarter. Lee may have some insight on that kind of number, but basically decent feed demand. And if ethanol production starts coming back, which I hope it does in some point in the future, more distillers grains in the ration. But in the short run, I think it's a positive for feed grain demand and feed rations. In the long run, it's tough to say, but I think maybe flat from last year to a little bit down.
Lee, can you explain more about current basis patterns that you're seeing versus the historical basis patterns for cattle?
Sure, and that's a really good question, and especially in a market like this where basis levels, when you had seen basis levels like this in the past, when we didn't have this capacity constraint, that was obviously a signal to market cattle, right? When you could take such a large basis And that was certainly incentive. In this situation, it's much different in the fact that it's the ability to market cattle, not necessarily, can I get a bid, right? Basis levels have been running historically high or at historical levels. It's similar that we do see the strongest basis levels here in the spring. Usually there's a rally in April, and then there's a rally May, June time period, and then we get basis levels to about par, at least here in Iowa, as we get into latter part of summer and into fall. We've seen kind of those similar patterns, but they've also been stronger at times, and they've also been much more volatile too, as we've seen the futures market is really trying to find that market clearing price, right? And what's happened is it's overreacted at times and really hasn't underreacted at all. And so with that, those large swings, when we see daily limits and expanded daily limits, that's really caused a ton of volatility in that basis too, and really to get a handle on what that basis is. So, as I showed you on some of those charts for looking at estimating returns, it's a real challenge to me. I mean, I use the 3-year average because that's what the model's set up to do. But for a cattle feeder in this situation, what should you use if you do see an opportunity to hedge? A lot of those opportunities to hedge are well behind us, especially when we're looking at kind of near term, and especially some of the placements. Maybe there's some opportunities in the deferred months, but I think that's going to continue to be a challenge of, how do I get those expected prices given what I'm going to use as a basis estimate?
Do you think capacity for slaughter in the United States will be changed in any way, whether it's shuttered, increases, small numbers get bigger, large capacity plants get smaller? I don't know. Do you see a change in how capacity is instituted in the U.S. after this?
Well, I think this is really a two-part discussion. So the first is, do we have sufficient shackle space? And I think the argument can be made that we don't have much of a cushion there. So operating normally, I think given the additions we've seen, especially in the hog industry over the last several years, some of these brand new plants can operate so efficiently. We have capacity. Now in the fourth quarter of the year, I think even before this COVID-19 situation, that was going to be a challenge given what we were forecasting for hog supplies that were driven by that strong demand for especially our exports and filling that Chinese market. But we were going to be able to work through those supplies given the capacity that we had. Now, what this has shown is kind of a vulnerability in that capacity, but it's not the vulnerability in really the size, but the ability to operate these plants and where these plants, I think, are particularly located. Now, obviously, they're located where the hogs are because of transportation logistics, and that's just how it needs to be. But you're seeing in the case where with the labor supply being impacted, that's impacting the ability to operate these plants. So even if I had twice as many packing plants or twice as much shackle space, that's not going to really change my ability to process hogs because I'm constrained by the labor force. So does this potentially change? I think it does spur some research and development further into automation, robotics, possibly at packing plants as a natural insurance policy. Do we see a little bit more cold storage being built as a natural insurance policy there against logistical issues that we've seen here? When you compare the cattle industry and the hog industry, I think you've seen a little bit of differences when you look at the packing sector. It is distributed a little bit more. So we have packing plant here in Iowa, Nebraska, Kansas, Texas. You look up in Washington State. Well, with that geographical dispersion and states being impacted at different times and at different rates by COVID-19, that potentially helped to maybe mitigate this a little bit. Now, we've obviously seen those slaughter numbers down significantly for cattle too, but maybe to get those plants back online or ramped back up, maybe a little bit easier because of that geographical dispersion. With the hog industry and those being centered here in the Midwest for the most part, we're peaking now and seeing the impact much more on our labor force and our ability to operate those packing plants.
Somebody wants to know on a related issue, whether this will be a political issue in Iowa's 4th district, and I looked it up. It takes up an enormous amount of Iowa, from Omaha through Des Moines, all the way over to Waterloo and up to Sioux Falls, so including Mason City. So just a great big space.
So what is the specific question?
Will it become a political hot potato, meaning breaking up some of the capacity?
You know, that's a question I don't really have an answer for. You know, I think it is important to remember that it's incredibly difficult to operate a packing plant, and there's tremendous economies of scale at those packing plants. As that graph I showed you earlier showed, that we have, you know, the majority of packers are very small, right? But they just can't handle that many hogs through that plant, and the cattle situation is very much similar. And so when we look at an industry, the industry's been able to grow, and been able to grow because of the strong demand, both here domestically and on the export market. So our ability to deliver that product, that's safe, that consistent, that volume of product is predicated on the ability of the supply chain. So we need all of the supply chain. There's a role for all sizes of producers, all sizes of packers, to meet each individual market. When I started digging into some of this data, seeing the number of products coming out of packing plants and the various outlets they go to, it's a tremendous looking at. And even just from byproducts to the raw cuts that are coming out and further processed, it's such an intricate supply chain that could not be accomplished at a much smaller scale because of the economies of scale that we can get from these larger packing plants.
I should clarify that they're asking actually about the vertical integration part of it.
Sure. Okay.
So is the vertical integration a problem, and will that become a political issue?
Well, I would extend that to the vertical integration too. It's enabled the industry to deliver pork to consumers at competitive prices, and also, very importantly, been able to respond to consumers' tastes and preferences. In the pork industry is incredibly flexible and nimble and swift to respond to demands from consumers we have here in the United States and on the export market. And the vertical integration, the alliances that we've seen, have very much enabled the industry to do that.
Oh, I'm sorry. Do you think any cattle will have to be euthanized?
So I think when you look at the cattle industry, we're obviously backing up cattle supplies. But I think it's important to remember with the cattle industry, the structure is much different. The hog industry, it's very much, it's predicated on that a flow of pigs. When I have a group of pigs that are ready to go to market, it's because I have a group of pigs right behind them. It's a just-in-time supply chain. For cattle, there is some more flexibility in the sense that we don't have the infrastructure constraint. So cattle being raised in open feedlots, some confinement feedlots, some on pasture, especially at the cow-calf and sometimes stocker stage, eases that constraint some. And so that gives us a little bit more flexibility. We can buy a little bit more time in the sense with the cattle industry, we don't have necessarily the cattle coming right behind them. They can be staged in other ways. We can retain ownership on a farm for longer. We can just buy long yearlings to put in feedlots at a later period of time. And so I think we've seen times in the past where the market doesn't get very current, and we can allow the packing capacity to catch up. So I think as we've seen here, yes, we're building up those supplies of over 120 days, over 150 days. But in the cattle industry, we aren't in the scenario where we need to remove animals from the supply chain. We just need to focus on working those animals through the supply chain and not backing it up. And just importantly, in not backing it up is being able to stage those animals at earlier stages of production.
Just a couple of more quick questions. We're at the top of the hour, so we're really done. So make these short. What's the market situation for selling and transporting hog breeding stock to China? Is there an opportunity?
That's a question I don't know.
Okay.
I think, my only quick 2 cents there is, we've lost, with all this attention to COVID-19, really the situation with African swine fever hasn't changed in China, in the sense that they're still rebuilding, trying to restock their herd. They have a large protein hole, especially when we look at the pork industry. That's why they're up so strong in demand for U.S. pork. So again, that's why we need to work through this challenge, because they're a market that's going to continue to be there. And even so, I think in the rebuilding of the herd, there's a lot of opportunities to serve that market.
And Todd Hubbs, finally, any reason to think that the acreage mix in the United States would change because of the situation for livestock?
Not the livestock situation per se. I think maybe the shift between the soybean corn price ratio, you may see a few less corn acres and a few more soybean acres. The market perspective planners report had corn at about 97 million. You see maybe 1.5 million down, maybe switching over to soybeans, maybe some spring wheat, but I'm not too optimistic that we'll see a huge jump in spring wheat acres. So you could see 1 million to 1.5 million, I think. I would be pleasantly surprised if it was more than that, but I don't think it will be.
Our thanks, of course, to Todd Hubbs, who's an agricultural economist here on the Urbana-Champaign campus of the University of Illinois, and Lee Schulz from Iowa State University for taking so much time with us today. That wraps up this edition of the FarmDoc Daily Live Coronavirus and Ag webinar. For Jim Bolts, who's our technical director, you have a good day. I'm Illinois Extension's Todd Gleason.